So good morning, everybody, and a very warm welcome to the GL Law MGroup and Bourlet Consulting webinar this morning. It's lovely to see some familiar faces and some new faces. I wanted to start with a few introductory comments and an introduction to those that will be presenting this morning. First point to make is please do ask your questions. We've got the everyone button on the chat room, so please use that rather than individually emailing us or chatting to us. That'll make it easier for us all to see the questions. I can tell you from looking at the audience list that we've got a lovely selection of people who, some of whom have been through this process before, from my knowledge. In fact, I think some of them have been through it from the buyer's side, which is interesting. We're looking here, obviously, at the seller's side. Some of you are advisors, and that's great to see as well. And some of you perhaps are just contemplating a sale. So this morning is all about the idea of sale, that very first inkling that that's something you might want to do, right through to completion of the sale and receipt of money at the end of the process. And we have a real expert panel for you this morning that are going to talk through that whole process, starting with Robert Johnson of Bourlet Consulting, who will talk about working with clients at two stages, which is a question of timing, is it right for me, and financial planning aspects. We then go on to two members of the M group, that's Mark Crossfield and Geoff Pinder, and Mark's going to talk about four key factors that are going to affect timing, which is all important, obviously, for valuation, and then Geoff is going to talk specifically about valuation, and then I will round off with some comments about the legal process and what you need to know. We then, that will take us through to, we hope, about 10 o'clock. And then Joe will collate questions and we'll deal with anything that's come up during the course of these presentations. So we will, if the ebb and flow really gets going, we'll open up the microphones. But for the moment, we'll keep you all on mute and just put your questions in the chat room, if I may. Just to say, anything that's said here is confidential. I know that it's a highly confidential process. Years ago, when I was a much junior lawyer, I sent a letter out, or perhaps a colleague did, with "Sale of Your Business" as the heading of the letter. And of course, it was seen in the post room back in the days when post was still a thing. So I'm very careful to call all my sale mandates projects and give them some anonymous or rather made up name, so it's not too obvious. But yeah, the principle being, look, we'll keep everything you say here confidential. We do want to share it with people though, so we are going to put it on the GL Law YouTube channel with a private URL, so you can access it to look at it again if there's anything you missed. So look, without further ado, I'm going to hand over to Robert. Robert Johnson, Bourlet Consulting.
Thanks for your introduction, Paul, and good morning, everybody. Nice to see some familiar faces too. I'm Rob Johnson, Director of Bourlet Consulting, and I'm delighted to be here today to discuss the 4 steps to success in the context of a business exit. It's a subject that's got lots of moving parts, and for business owners can lead to life-changing events, both from a financial and personal basis. And that's what makes it such a great area to work in. So just to set out the roles across the professional team this morning, as market makers and catalyzers, Geoff, Mark and Paul will be that part of the discussion. In our role, we help and support business owners plan their finances in the run up to and hopefully through a successful structured exit, so they can go on to enjoy whatever they'd like to do in their next chapter. Our business is both chartered and accredited, and with our business clients, we look at the big question of how much is enough. We work out how much money is needed in later life to make sure that the lifestyle that they plan for themselves actually materializes. And the chances are that if you're an owner manager of a business, you've been able to successfully monetize what it is that you do and pay yourself a salary and dividends and other benefits as your reward structure. At some point, though, the time will come when you're going to want to stop an exit. And from what we've seen, a couple of things really stand out. Firstly, the best exit is a planned exit. Even though it might not be terribly straightforward to achieve for lots of reasons, timing, as Paul mentioned, and we'll come on to that a bit later, deal structure, investment partners, and it just might not be the right time for your business. And secondly, it's a really big change. Handing over the reins of your business to somebody else when you're financially and emotionally invested in return for a cold sum of money sometimes doesn't really sit that easily from experience. So in over 15 years of working with exits from businesses as diverse as high pressure plastic moldings that create swans, to electrical engineers, events companies that do big stadiums, partners of legal practices, Paul, and software developers, we've identified 5 sort of key tipping points that prompt that more serious thinking that this is possibly a good time. And these are number one, it's time to cash in. While the going's good, it's a great time. The order book's full. It's looking really rosy, and it just might be a great time to take the money. Number two, the opposite of that, risks in the business. They're just getting slightly uncomfortable, and it might be a better place elsewhere. Number three, retirement, or maybe a bit of just general burnout and just had enough, or maybe some family or health issues. Number four, potentially a common one, where co-owners or investors are going in different directions, and maybe the view you might have isn't necessarily aligned with others in the business. And the really positive one, which is where you think there's more opportunity elsewhere. And it can be some, all, a combination of all of those. So when the time's right for you, it's likely you're going to want to extract yourself and monetize the future profits from your business with a buyout of your share to replace your current rewards of salary and dividends. And over the years, we've seen deals of all shapes and sizes. And if you're really lucky, it's cash up front and you can walk away, but it's much more likely to be some cash up front and small payments in various forms over a couple of years. And that's principally to achieve a really smooth handover and protect your own and also the investor's value. And as long as the business isn't just you, your business will have a profile in the marketplace, and there will be ongoing passive interest. It'll have a sort of intrinsic value. It's just not got that crystallized extrinsic value as yet, because the deal has just not been done. And any deal is going to have to feel right. Is it right for you? Is it right for your customers? Is it right for your staff? And is it right for the longevity of the business? And for some sellers we found, whilst money is clearly a really important hygiene factor, the choice of buyer and deal shape is sometimes equally as important. I mentioned a bit earlier about timing. Well, that's the difficult one. And having spoken to numerous clients over the years, this is the element that they find most difficult to manage. But there are things that can be done to control this part. The earlier, the better the planning, the more successful the deal. I mentioned that earlier. Nobody wants a fire sale. So what do we mean by planning? Well, I know Mark and Geoff are going to come on to this a bit later, but in our experience, it's just having those really difficult conversations internally. So you've really bottomed out sort of any key issues to satisfy yourself and co-owners. And you've sort of done your own due diligence internally and imagine that maybe if you were buying your own business, what would you be doing to improve it, to make it look sale ready? And you've engaged with the partners that you're comfortable with. And we'll come on to this as I chat through a personal story a bit later. And you might even have a figure and shape of deal in mind, but you've not got that control of the who and of the when and obviously of the how much. So if we were to sort of come to a hard stop, if somebody knocked on your door with an offer today, would you be able to say, sort of hand on heart, that you covered all the bases internally? What we find is that the business is the focus for most people, and clients haven't really considered the finer details in a personal context. And the big question of how much is enough for themselves hasn't really been established. And it just might not be the right time for the offer. But if it did come out of the blue, it really does crystallize the thinking and put a spotlight on the issues at hand. And to try and illustrate this, I'm going to tell you about the circumstances and outcome of an offer of this kind in my family business as I was growing up. I sort of watched from the sidelines. So when I was about 11 years old, both my parents worked, and I got shipped off to my grandparents to, sort of inverted commas, work in the family firm in the summer holidays. This is ancient history. So this is 1973. So it's Vietnam, oil crisis, Sunderland winning the FA Cup, if you can imagine that. The business was a TV rental and repair business, which started in '67 by my grandfather, Frank. And at the time, most people rented their televisions. They were really expensive to buy. They cost about £3,000 in today's terms. So no Netflix, no plasma screen, no remotes, and you actually had to stand up to change to one of the other 3 channels. My job was to take calls in the shop and book in the repairs and go in the van to diagnose the issue. And if it wasn't the aerial tuning, the TV was carted off in the van. But the year before, Frank had been at a trade show in Manchester and was packing up his stand on the last day when he was approached by a delegation of Japanese businessmen. And they said that they needed an agent to sell their colour televisions, and would Frank be interested? They were flying out the following day. They needed a deal. And they shook hands on the deal. The delegation was from Sharp Electronics. So Frank's business expanded from mending and renting black and white televisions to selling and renting colour tellies, which cost about £6,000 in today's terms. And because of the cost, most people opted to rent again. And the rental roster for the firm grew to around 750 monthly paying customers that were using, this takes you back, direct debit mandates, but just literally been introduced at the time by the banks. And over the next couple of years, the business just exploded and money just poured in. And Frank and now my Uncle John, who joined the business, their lifestyles expanded with it. So for John, it was a big house, a swimming pool, 2 cousins at private school, a couple of expensive cars, and a yellow Ford Escort Mexico, which he used for rallying. And by then they had 26 shops, mostly pretty highly geared, and a turnover in today's terms of about £6 million. And as time passed, and the deal that they had, which was exclusive for 12 months, ran off, Sharp suddenly realised that 26 mostly pretty small shops in the East Midlands selling their electrical kit didn't really cut it for them, and they withdrew the deal roughly about the same time as they signed their deal with Manchester United. And over time, the other manufacturers that supplied the business also pulled their deals, and they wanted to sell their products through Currys and Dixons. So 26 shops, nothing to put in them other than the TV rental business, was quite a serious worry, and some very serious financial pressure and some difficult conversations. But over the horizon, in 1983, JVC introduced video recorders, and same business model, sell and rent video recorders. But the key part for them was that they could use the shop space to rent films overnight to watch on the new VCRs. And shops, all 26 of them, were refitted, and they got racks of the latest films. And West End Videos, spanning 26 shops across the Midlands, was born. And money poured in again, and lifestyle continued, and some years of significant success followed. And then, and this is the point I'm coming to, then the defining moment, they had a call from Blockbusters, the US video library chain. They wanted to talk, and meeting was arranged. And Blockbusters' position was that they were new to the UK, and they wanted to buy a business off the shelf because they wanted a rapid expansion. An agreement to buy the shares of the company holding West End Videos was finalised, together with buying the stock, taking over 26 shops, mortgages and leases. That was a critical part. And the staff were to be employed, and a pretty large cash deal was tabled. And then it stalled, and Frank and John decided to walk away. And at that moment in time, the business was really successful and profits and earnings were brilliant. And they had an associated lifestyle with that success of the business. So set against those sort of personal investment and emotions of running a business was a pretty sizable, sort of fairly meaningless lump of money for them. This is 1989, and John was 42 and Frank was 65. But as you would imagine, that wasn't the end of it. Blockbusters did want a presence in the UK. They had very deep pockets, and they set up a shop literally next to Western Videos quite often, and they dropped the prices, and they had a much smarter deal on the properties. So when I met with John in the years afterwards, I was really keen to know why he'd not taken the deal. It turned out that Frank wanted the money, but John didn't. And some of the reasons might resonate with you if you run your own business and were presented with your own hard stop and you had an offer on the table for your business today. And chatting to him over a whiskey, which is what's his modus operandi, later in the evening, he just didn't know who to trust in the deal. I didn't know really whether the deal was a good deal, whether the valuation was fair. So it ended up being nobody, and he walked away. And he just didn't know how to go about it technically. He'd done everything himself, on typical entrepreneur, and he was quite reluctant to take outside advice. And he didn't know what to do with himself after the deal. He was rather defined by his business. But the biggest single issue for him, and deciding not to take the deal, which caused, as you'd imagine, interesting discussions in the family, is at age 42, he didn't know whether he had enough money or not. They just weren't in an informed position, and they didn't have anybody in the corner to rely on. So this personal experience isn't the reason that our firm works with business owners, but it does inform some of the discussion pieces and the considerations for somebody courageous enough to run their own business. And our firm didn't exist when all this happened. And had we had the opportunity to work with Frank and John, we would have been able to help John with his big question of how much was enough. And the first thing we'd have advised him to do, and it's the big question to go with for him, it's to think about what's important to him and his family in the wider context. That's the big question. So what his financial priorities are as far as income and capital expenditure are concerned, and have an idea of sort of quantifying how much this is going to cost and when that might be going forward. And we all appreciate these are huge questions and need careful consideration over time, which is all the more reason to consider them in advance, really. And knowing him, he wouldn't have wanted to make any snap decisions under pressure. Once he'd have reached a landing on that, a tax investment strategy can be worked out. And to illustrate the process, we would have been able to put a cash flow together for him. And we're going to move to the slides in a second. And what this is this bunch of slides is a sort of rudimentary look at what we do, which we do in a lot more detail. So we firstly draw a timeline, and we put the timeline into 3 sections. So the first section is just in the run up to any form of deal. So you're continuing to work. And the next slide, costed, and the next slide. And you would still continue to receive those salaries and dividends while you're in that planning phase. And then the next slide is going to show the actual deal itself. And this particular shape of deal is a chunk of money, and then a staged process over time of money being paid across to you. And the next slide is where you may have other forms of income, state pensions, defined benefit schemes. And the next slide is going to show the key part, which is the big discussion point as far as John was concerned, was to just look at the expenses position and just understand in a bit more detail what that might look like. And our role in all of this, and the next slide, is to look at those expenses, and on the next slide, and answer that question. We've got a very nice piece of software that we can use and bring to bear on this, which looks at the calculation that's required using different investment strategies, and it can determine from that structured process any potential shortfall in capital income with the cash flow, and that would have certainly helped John visualize his future in financial terms with the deal on the table. And this is just really there to provide an education so he can make an informed choice rather than a choice which is, for him, I think, was principally based on in emotions. So that's the end of my part, and I'm about to hand over to Mark. So he's going to address the aspects of the deal. And Mark, I'm going to hand over to you at this stage.
Thanks, Rob. Morning, everybody. Yes, that's a good story, Rob. It's interesting to know that it is ultimately about timing, which is a kind of grand thing to say, but there are so many factors that affect the decision to plan an exit, and they are extremely numerous. But they're often very specific to the individual company or the owner. But they do generally fall into several key areas, and the slide that's on the screen now kind of summarize the four that I really want to touch on, namely economic, financial, personal, and resources. Rob's touched on a number of these, so I won't dwell on them too much, but just to sort of have a quick whirlwind tour through some of the factors that will impact on your business, some of the things that will sideswipe them, and some of the things you just won't know about until you kind of fall onto them, as it were. So economic market factors is the first one. These are situations that arise as a result of a cyclical, or seasonal nature of a business or sector. It may be that a particular product, for example, has a life cycle, and it's reached its maturity and will begin to decline, or that there is a change in legislation, for example, forthcoming, that changes the landscape of the product or the market. There are many other factors that influence the market, such as technological developments or environmental conditions, and every business will have areas that are susceptible to certain factors that are often commonplace. Trends, fashions can also play a role, for example, and any business will want to monitor this and be aware of the changes that are happening in their particular sector or marketplace. Financial. I think in financial, there are both good and bad situations, as I'm sure you know, and these can surface from time to time. And whilst the bad is not welcome, it may mean that a decision to exit is considered sooner, such as, for example, cash flow issues or a loss of a key client. Positive performance, however, and the correlation to growth of the business is most certainly does come into focus. And these are difficult areas to consider. Typically, business will not want to sell when times are good, but equally a buyer, for example, will not want to see a business shrinking or stagnating, as this will have an impact on valuation, which we'll come to shortly. It may also be that the case that the owner believes they have made enough money or capital growth in the business, and the time is right to crystallize their investment. Perhaps, for example, to a management team or through an employee option trust, where the owner is far more concerned about helping another generation to succeed. This leads on to the third point, which is personal. The selling of a business is indeed highly emotional and personal, as I'm sure you will know, and it's very often the most significant factor in the decision to exit. Just how are you feeling at the time? Is this right? Does this feel right? Leaving a legacy may be an issue, or indeed being philanthropic, you may lead you to setting up structures that satisfy the owner's emotional stance, such as I mentioned previously. Often illness and of course the aging process that we're all prone to often come into the equation, and not least because it focuses the mind on the next step in your lifestyle. So, you know, these things sometimes come about and you don't know that you'd expect them to come around the corner. So these situations can be enormous influences on timing and preparation, and often come into play all too soon, leaving very little preparation available and the time available to do that. Lifestyle and work-life balances are issues that become more in vogue over the past few years, and it focuses the mind on owners to ensure they better enjoy life as a whole. Considering if you want to spend more time in the business and not living your own personal lives is important and worth considering. Finally, resources. I think the last key factor is a decision to sell. And in a decision to sell is availability of certain resources. It may be that staff recruitment, for example, is becoming tight, such as we're experiencing in the market now, which may impact on costs or growth plans. Could be that the age profile of the staff, for example, is such that fresh blood and fresh ideas is needed. Whatever the circumstances, however, these are important factors when thinking about whether there is more growth to be gained staying involved in the business or to consider planning an exit now. Other resources, for example, such as premises, assets, cash, are also important, and without regular investment, businesses can suffer from keeping themselves competitive or indeed modern. Premises size, suitability, condition will also impact performance and indeed the growth of the business. So, are these areas that you need to consider investing in, and is this the time to stop that investment and perhaps to get out? Finally, cash. I mean, this is the lifeblood of any business, and this may be diminishing, which again will need reinvestment, topping up, replenishing in due course. So decisions to reinvest and improve resources are often costly, and depending on their circumstances, of all of the above factors may lead you to decide the time is indeed right. In summary, these are many factors that come into the exit conundrum, as I call it. One additional factor may undoubtedly be the business itself and its worth. In other words, the valuation of the business. This is key, of course, and Geoff will begin to explore this slide with you now. Thanks for your time. Over to you, Geoff.
Thank you, Mark, and good morning, everybody. My name's Geoff Pinder, and I work alongside Mark in the MGroup corporate finance team. We help business owners to understand the full range of exit options available to them, and we support them in the deal process from start through to finish. I've got the opportunity to talk to you now about business valuation, and for me, it's probably one of the most emotive subjects when it comes to selling your business. Over the best part of nearly 20 years now, I've seen hundreds of company sales and across most business sectors as well. The vast majority of these, thankfully, have resulted in very successful outcomes for the owners, where they've been able to exit, confident that the future of the business has been secured, and importantly, their value needs have been met. This has been made possible with the help, typically, of good, experienced advisors supporting them on that journey. When it comes to selling a business, experience, though, has taught me one important lesson, and that's to never try to second guess the value of a company before testing any assumption in the market. We've heard from Rob already about the reason people might want to exit. We've heard from Mark about the decisions on timing. For me, there are a number of consistent themes that I see when it comes to business valuation, and they're summarized here on this first slide. Firstly, it might be stating the obvious, but every company is different, and not surprisingly, so is every deal. Most people see estimating the value of the business as both an art and a science. And one thing for sure, it's never just about a mathematical calculation. I'm going to come to these factors shortly, but there are many, just as with timing, that can affect valuation. We do sometimes find that there can be significant disparity between one buyer's assessment of value and another's. And this is certainly no criticism, but we also find that an owner can have a certain set almost rigid view on value, but this isn't always aligned with how the market is valuing a business. For many owners, and possibly on this webinar, the business has become your life. You've made sacrifices, you've made investments, you've taken risks, and selling is very, very personal. It can therefore, not surprisingly, be an emotive and challenging experience. And finally, for me, when owners have a clear objective and they're motivated and committed to the sale, in other words, they've got a strong reason why, for example, retirement, or maybe wanting to improve that work-life balance, the chances of realizing a successful sale are greatly improved when there is that strong reason why. When I first started working in company sales, a very experienced colleague shared a quote with me, which I've added at the bottom of this slide. You might have heard it before. A company is worth what somebody's prepared to pay for it. For me, this still holds as true today, now, as it did back then. And therefore, it's hardly surprising that so many people want to understand the value of their business. For many companies at the moment, and we saw a lot of this in 2021, and I'm sure we will in 2022, acquisitions have become the go-to solution to enter new markets, to diversify revenue streams, improve profitability, drive growth and expansion. When it comes to selling your business, we believe that value is dominated by three key concepts. Next slide, please. Firstly, the level of risk to the purchaser. When it comes to spending money in most walks of life, low risk typically equals higher price, and high risk typically equals lower price, possibly not surprised at that. It therefore follows that if you can reduce the level of risk, whether that's real or even perceived by the buyer, this should translate into a positive influence on valuation. Some examples of risk could be the market is declining, technology that you're using is aging, or maybe there's no management succession in place. An experienced and knowledgeable advisor will be able to help you mitigate these types of risks when it comes to selling your business. Secondly, the return on investment that the buyer will receive. A buyer with strong strategic fits can leverage various economies of scale. What does that mean? Well, things like sharing of resources, cross-selling of each other's products and services, maybe cost savings can be achieved. As a result of these, they can grow sales, increase profits more rapidly, and accelerate as a result their return on investment. This should be positively reflected in their valuation on the business. But the key here to be able to work with an advisor that's got the skill to identify the types of buyers that will be able to see those economies of scale and put them into practice. And then finally, the most important factor of all, bidder competition. This is actually quite simple. If you can create a competitive market, you'll be able to drive value up. This also gives you choice, which is a very important factor when you're selling your business. When it comes to selling, some might say cash is king, but in fact, choice is king, and you can see that in the quote at the bottom of this slide. Why? Because choice can affect the price of a deal, it affects the terms of a deal, the speed of a transaction, and for some, possibly the most important thing of all, it means you get to choose the cultural fit of your buyer. In other words, you can choose the right home for the business. Next slide, please. As I mentioned earlier, estimating the fair value of a business is seen as both an art and a science. From our experience, though, we've pulled together actually quite a short list of some of the key business characteristics that we've seen affecting valuation over the last 10 years. And it's far from being exhaustive. I'll try and get through them quickly. Firstly, how well established is the business? Is it a recent startup, Or does the business have a strong brand, great reputation, and a proven track record for delivering excellent service? What about the sector and the market? Is there lots of acquisition interest and deal activity in the market sector? Are buyers being attracted into the market? And if so, what's driving that activity? What about the location? Would an acquisition in a specific location give a buyer the geographical presence that it's looking for to enable expansion? Or maybe an overseas buyer might want to get a foothold in the UK. Currently, about 30% of our business sales involve an overseas purchaser. Scale and profitability. What's the size of the business? Are your revenues and your profits growing, or are they declining? And if so, why? What about the team and the management, their capability and their skills? We often see an acquisition can be driven by this reason alone, where the skills, experience, and expertise of the team is the key reason why a buyer is interested in making an acquisition. Synergistic benefits. I mentioned some of these earlier. What economies of scale can be leveraged by a buyer that's going to make that business more attractive and be reflected in value? Recurring or repeatable revenues. How much of your sales can be considered contracted or guaranteed, making it reliable and secure? Buyers really like to see these characteristics. Future growth goes without saying. A buyer is interested in where those opportunities are for the future and how they can be realized. And then we've got the assets within the business: machinery, equipment, property, stock, technology, intellectual property. Have you invested in these things? A strong balance sheet can help a buyer raise finance on a deal. Reliance on the owners. What that should really say is, what we want to see is a low reliance on the owners. This is a really important area. I've seen this trip up so many owners on different deals when it's not handled well. But have a think, if you're planning to leave the business at some stage as a result of sale, whether it's day one or maybe after 12 months, ask yourself if the business can function efficiently in your absence. And if not, my recommendation would be to start putting into place measures to mitigate this as soon as possible. What about your customers? Are you reliant on just a handful for the majority of your sales? This type of reliance can equal risk in the eyes of a buyer. Think about how you can spread that risk and widen that customer base and make it more diverse. And finally, back to that reason why. Are you escaping declining business, or is there a genuine reason why you want to leave, such as planning your retirement? There's probably another factor that's occurred to me that could be on the list, and it's based on experiences over the last 12 months, and maybe many people on this webinar have experienced this in their business. But the robustness of your supply chain is becoming an increasingly important factor. And you might be looking through this list and wondering which of these factors are strengths in my business and which are weaknesses. Rest assured, like many of the presenters on this call, I'm yet to meet the perfect business. But what I can say is, with an experienced team of advisors around you, we can help to emphasize the strengths in your business, but also importantly, mitigate any of those weaknesses. Next slide, please. And so just some final thoughts now. With an understanding of those three value concepts and the key value drivers, I'll finish off by sharing how most buyers now apply these types of principles when they're valuing a business. You won't be surprised to hear that there are many valuation techniques and formulas out there. Indeed, there's been many books written on the subject. But from our experience, the most common methods that we see are listed here. And the number one by far is the first, a multiplier of profits or revenues. A multiple of revenue is often used with certain technology businesses, but it's very specific when it is used. By far the most common approach is a multiplier of sustainable profits. The profit multiplier takes the sustainable profit value of a business and then it multiplies that by a number consistent with the averages known for comparable company valuations being achieved on deals within that particular sector. But the key here is to make sure that you've got an experienced and knowledgeable advisory team working with you who really understand these techniques and can make sure that they negotiate maximum value on your behalf. Secondly, an asset-based valuation. Well, like the name suggests, really, this adds up all of the market values of tangible assets in the business. And I've mentioned some of these already: equipment, machinery, premises, stock, vehicles, but also intangible assets like customer goodwill and intellectual property, possibly seen as more simple by some buyers. But again, there can be negotiation, debate over the value of those assets on the balance sheet. And then finally, cash flow analysis, sometimes referred to as discounted cash flow. We don't actually see this method applied that frequently, and there are some who consider it to be overly complex. So I'm not actually going to spend any time on this. But what I would say is, if you want to know more about any of these techniques, then we'd be more than happy to share more information or have a conversation after the webinar. So, in summary and conclusion, for an owner looking to sell a business, business valuation, not surprisingly, is an incredibly important and emotive area. Getting it wrong can be costly in both time and money. But, and this is a consistent theme through this talk, good planning, good preparation, the support of a corporate finance advisor can result in very, very positive outcomes for you. So thank you for your time. At this point, I'll hand over to Paul. Thank you.
Thank you very much, Geoff. So I'm just going to start my section here, and we've got about 15 minutes. So I'm going to give you an overview, quite a broad look at the experience of selling from the perspective of you, as it were, i.e. the big U in the center of that circle there. And that's the typical owner manager juggling business and family, and we're going to have a narrow look at some specifics and a broad look at other matters. We've talked about emotion, haven't we, quite a bit in this talk, and how important that is in this process. What it's taken me quite a bit of time to realize is that this is really a personal decision. This isn't really a business type decision. We tend to think that when we're wearing a business hat, we're acting in a sort of very rational way. And yes, running a business and being a director of a business does give you a sense of objectivity. But here, this is about ownership. And I think it's really important to remember that very key fact, that this is personal, i.e. your personal property, your shares. And I would say, be brave in terms of accepting that decisions are emotional. I've don't know if anyone's read Jonathan Haidt's book. It's called The Righteous Mind, and in it he compares decision making to an elephant and a monkey. The elephant decides to go towards the banana, and the monkey agrees to go with the elephant. Now, somebody looking at the two might think that the monkey was in charge and steering the elephant, whereas in fact it's the elephant that's making the decision and the monkey that's going along with it. The point is that the elephant is your emotional self, and the monkey is your rational self. And the other point, of course, being that we tend to do some post facto rationalization of decisions that just feel right and we want to make. I would also, because I do think decision making, and this is really the rest of my talk, and what decisions you will need to think about as you go through this process of thinking about sale. We can refer to Spinoza, who came up with 3 ideas of how decisions are made. And I think we can be guided here by him. First of all, emotional response. Secondly, a sort of rational, logical thinking through. and thirdly, our own experience and using our experience. And the key, he thought, of all those three was experience. But he also said, rule out sentimentality. That is not the basis of a good decision making, and I think that is also a very good guide as we come through this process. So, what does this sort of pizza chart show us? Really, it's saying that when this is called a business life plan, and it says that when something in one of these sectors begins to get a bit more active, you probably will find that the other sectors will get a bit more active. So we've been talking this morning about the sort of 10 o'clock, whatever that is, sector. In other words, business company partnerships. And we're talking about you'll need some legal and you'll need some tax advice. And we're talking to business partners, co-shareholders, buyers and sellers. That's become very active for you. That's where you're thinking. But you will also find that you're beginning to think, and you will inevitably have to think about those other things like legacy. And we've touched on that today. We've touched upon it in terms of legacy for your business. What type of buyer do you want? You might have I mean, as suggested in the chart there, a legacy equally for other things, for your children, grandchildren, family investments, foundations, charities. Similarly, you know, moving around the circle. Well, we've touched on children and grandchildren, family matters, jobs, offices, etc. You might be planning a sort of non-exec career after this. That might be part of what you're thinking. You might, in fact, this might be part of a sale where you're staying on. It actually could be a new chapter for you. So maybe if you were Rob advising his uncle, you would say, go and be a managing director of Blockbusters, you know, that sort of idea. And of course, we also look at other types of assets, including property, shares and investments. So, and I touched on that a bit later, that those shares in this case could be shares you've acquired as a result of a share swap, where you're getting shares in the new business and in return for your shares in the business you own. I'm conscious that when we talk about exit and selling, we very often automatically think of a trade buyer, and that tends to be the default sort of model we talk to. But of course, there are other ways that you could be selling. You could be selling to your existing management team. And one of the questions in the chat room I see is about funding that, and we can come into that in the answers. And the other thing that's other way of selling is it's becoming there's been a lot more focus on it recently, is selling to employees. So that's also available. So a sort of management buyer, but actually that's very specific. It's kind of within a tax straitjacket. And it's a sale to all the trustees, in fact, to the trust to a trust of all the employees, I mean to say. So bear that in mind, all different types of those three different types of sale that we could be talking about, and I will try and cover that in these next few slides. So next slide, please. So what's important? What decisions should you be making or be thinking about making? And that's really the purpose of these next few slides, and really to try and help you, inform you about those decisions that are coming up. So key thing is to keep the business running whilst allowing time for the sale. So you can be thinking about this a couple of years in advance. And of course, that makes the business more sellable. We've heard that earlier in the talks, that actually, if you've stepped away from the business, that's a good thing. So if you're nose to the grindstone now, think about ways in which that could change, and how you could delegate a bit more. You will be needing to negotiate some of the deal terms, but as Mark and Geoff have said, you can get an awful lot of good advice and be guided on that. It's interesting, one of the talks I went to recently, you can crunch through some of the really big valuation points quite easily. And then you have this sort of formula that works on financial information. And quite often these things are called, I mean, the way the formula works is cash-free, debt-free. So you then have a long argument discussion with your buyer. What does actually debt-free, cash-free look like in your business? So you really get into nitty-gritty. So you can then spend sort of 90% of the time discussing 10% of the actual value that's attributable to that element of the price. So as the slide suggests there, good financial information, and by that I mean accurate and very up-to-date financial information, is absolutely critical. So if you haven't got that in place, please do something about that. You will need to tell the staff at some stage that you are selling, and that's a very difficult and very personal, I would say, decision to make. I've some sellers that I've dealt with, they come to me and said, we've already told the staff that we're doing this, and they're very happy. Well, that makes my life easier, because advising clients from a legal point of view when to tell the staff is a very difficult thing to do, because it is so personal. And then there are others who say, I won't tell the staff until I'm absolutely sure that the ink is dry on their signatures. So, you know, there are two different ways of looking at it. What would I say? There are certain rules if you're selling a business as opposed to selling shares, and those rules relate to something called 2P, which you may have come across, which is the transfer of employment protection of employment regulations. Now, those do require staff to be told, and normally a couple of weeks, maybe sometimes up to 4 weeks ahead of doing the deal. But if you're doing a share sale, you're simply changing the ownership of the company. So there's no underlying change of the staff terms. They stay in place. So it's really a matter of as you as an owner deciding when is right to tell the staff. But yeah, it's an important point, and not just for you emotionally, but for the purchaser, who will want obviously to have maximum amounts of continuity and stability within what is going to be a fairly unstable time for the business as the ownership changes over. Then in terms of the legal side, what do you need to know? And it's difficult to, I find this quite difficult to pinpoint. I suppose when I was a junior lawyer, I rather relied upon somebody within my client's sort of team to tell me, guide me what they wanted. And it wouldn't necessarily be the owner, it might be an advisor, and that's still the case. So as I've got more and more experience in this, and I've been doing it for 30 years plus, so I instinctively know what the answers are, and I instinctively will say to my clients, I think this is a reasonable position to take, and so on. But there are things that you will need to cover as part of this, and things that I can tell you. For instance, the sale process. If you look at that sale timeline, it's quite small writing. I wanted to fit it onto one line, but I'm suggesting here: consider sale, and that's 6 months to 2 years before you actively market. This is quite a long period of time, I know, but it can take 2 years to get your business absolutely right and produce accounts which show that. Again, I've put in a fairly broad spread there: 2 months to 2 years before you reach heads of agreement. We had one case we dealt with. It was on the market for I think it was 3 years, 4 years even. And they just forgot to take it off the sort of the bulletin board they'd put it on, and lo and behold, 4 years later, a buyer came along and said, "Yeah," and it paid absolutely top dollar. So they were very, very happy with that. And once you've reached heads of agreement, it goes pretty quickly. You go through something called due diligence, which is I'll come on to in a second, the next slide, and the sale and purchase process. And that takes 1 to 2 months. So I mean, it can take longer, but you know, this needs a sort of typical indicative timeline. So I'm just trying to illustrate there that it takes a long time to think about sale, a long time to perhaps find a buyer, and then quite a quick time to finish the whole process. Personal liability there, I'm just going to make that point that don't be frightened of that. If someone says, you do realize you've got personal liability? Well, yes, because you are the owner and you're selling and you are personally benefiting. So the buyer will want to know that the information you have provided is accurate, and it's very important that it is. Yeah, so you would be expected to give these things called warranties and indemnities personally, which is to say, if there is a claim, you have to hand back some of the money that you were paid as part of the sale process. So next slide, please. So when to start the sale process? It's very important. I have had clients over the years come to me and say, I don't want to tell them that, or whatever it happens to be. Invariably, this thing they don't want to tell the buyer about will come out. Now, it should be much more a question of when should we disclose that thing that we don't want to disclose, rather than not disclosing it. That's a much more sort of constructive way of looking at it, because if you don't disclose, I think first of all, it makes it very difficult for your legal team. And I don't mean just, personally or anything, but it creates conflicts of interest, and it can create both that risk of claim, which is why it creates this potential conflict of interest, and it can create criminal liability, fraudulently dealing in shares. Obviously, that's at the extreme end. But yeah, you've seen these cases where companies are sold and it is absolutely not what was described. And the litigation that then runs goes on for years and years and years, and it's very unpleasant. So approach this with honesty and openness, and being sort of forefront of your mind, but with a strategic head on as well. You don't necessarily want to say everything all at once. You do have to be obviously commercial about these things. In terms of showstoppers, the ones that I've come across are ownership of company. In other words, it's really not clear who owns the shares, and that could be because it's not clear whether you've granted options. It could be it's not clear whether you have issued shares or not. And it's huge. The number of companies that I come across that haven't properly filled in their returns to Companies House, well, probably 80%, to be honest. It's much more than get it absolutely right. Litigation, if you've got litigation around your company, there's no way in my experience, you're going to be able to sell it. It's just too big a contingency. I mean, I don't mean, book debt recovery, that sort of thing. I mean, significant litigation affecting the company. And if you've got contracts that change on a change of control, that can be a showstopper. We had one where on a change of control, the director's service contracts went from being, I think, something like a 6-month notice to a 5-year notice. So, that put my client, the purchaser, off. You will have to go through things with a fine-tooth comb, the buyer's fine-tooth comb. Yeah, it's every single contract will be looked at. So be ready for that. And you will need a leader for if you've got multiple sellers. Choose one of you as a leader who will deal with the sort of dealing with the lawyers and so on, who can inform the group. In terms of how to go about the heads of agreement, I'm just conscious of time here. I'm just going to skip through some of this, but you'll see there, heads of agreement is a very important point in the process. So don't rush it. Be honest and be careful. In other words, don't sign something which isn't quite right, because it will just be reflected in every single document that is produced thereafter. And as you'll see with the SPA, which is not a SPA that you get at the end of the process, it's the share and purchase agreement. Create a good dialogue with your legal team and be clear about your goals and be commercial. By that, I probably mean be reasonable, and by that, I probably mean be prepared to compromise. Next slide, please. So how can we help? So at this point, we're assuming that, sorry, I think I might have missed a slide there. Can we just go back one? What can you expect on completion? Yeah. This is the sort of opening the champagne moment. So this is the cash, and we've seen Robert slide that big nice sort of podium with a great big a step up there. That's the cash you receive on completion. Bear in mind, it could be divided more than more ways than you might anticipate. If you've got option shareholders, you've got departing employees who perhaps you want to benefit, and you've got loan creditors who need to be paid off. But assuming that you've got those firmly in mind, which you will have done by the time you reach this point, you will know how much you're going to receive, and that would be should be. I would always advise that it should be a nice lump sum. Now, if you're talking about an MBO, it could be more future cash than it could be present completion cash. That's fine, of course. And as a seller, you may be more than willing to help your management team to buy you out. That's fine. But I have found it in my experience, a bit of cash on completion really helps everything along. It really creates a bit more urgency about everything. I won't go into detail about deferred and earn-out payments. It's a complex way of calculating further payments. And of course, you might be looking at shares in the buyer or in an SPV. That's a special purpose vehicle created for the purposes of an MBO. So again, if you're part of an MBO team, that could be you as buyer. Typically, of course, if you're selling out, you wouldn't expect to get shares in an SPV or in the buyer. You would be looking for cash or future cash. But if you're like Robert's uncle, you're 42 years old, maybe shares in Blockbuster would have been the thing to have done. Next slide, please. So how can we help? It does get technical, it does get difficult, and you need somebody with experience. You need somebody to know what's coming up next, what decisions will be needed to be made, and what the strategy should be to produce a good result with hopefully less emotional stress. That's the ideal outcome, and of course a nice sum of money at the end of it all. I won't go into too much detail on those points there. You can always ask me about drag along and tag along if you want. We are very busy at the moment, and we're not alone. I hasten to add, the market at the moment seems to be very busy. I think it's a COVID thing, to be honest. I think it's people realizing that actually now is a good time to get out, and maybe there's sort of pent up demand, and people realizing that now is a good time to agglomerate. Push businesses together to be more resilient for future shocks. I boast that we are clear on cost information, so I've tried to be true to my word there. How much is it going to cost? Well, very difficult to say, because basically the more complicated your deal is, the more it will cost. But there's an indication. That's what we tell clients. If we're a rule of thumb, 0.5 to 1% of deal value with a minimum of 12,500. So I hope that's helpful, and I'm going to open it up to questions. Back to you, Joe, please.
The great news is that the UK is in a period of strong economic growth, and we're hearing a lot about that from our own government at the moment. And that's presenting a lot of really exciting opportunities, particularly in business sales. Latest statistics is that there are more than 160 companies changing hands every month at the moment in the UK, and we expect 2022 to be a really strong year for company sales. So whether you plan to exit in the next 6 months or maybe 5 years from now, there's obviously a lot to consider and think about, as you've heard from our session today. But it's never too early to start that planning. With the skills, knowledge and experience of ourselves in MGroup Corporate Finance, GL Law and Bourlet Consulting, you'll be absolutely fully informed and supported on the journey whenever you decide to take that. We'd obviously be absolutely delighted to hear from you after today, and our contact details will be provided. For now, thank you once again for joining us. Hope you've taken a lot away from the session, and enjoy the rest of your day. Thank you.